for joining. Good morning, good afternoon, good evening, depending on where you're listening in from. Welcome to Thursday of Financial Inclusion Week, where a lot of the events have been focused on opportunities and risk, and it's one we're definitely going to dive into today. So real quick introduction. My name is Mark Degenard. I'm a manager with Accenture Development Partnerships, or ADP as we call ourselves. As a quick introduction to us, ADP is a social enterprise business model within Accenture that seeks to bring the people, resources, and capabilities of our global management consulting firm to the international development sector. And so we work with our clients in the international development sector through a co-investment model with those clients. A major focus of ours is financial inclusion sector and helping our clients identify and execute on the necessary steps for digital transformation. A major component of that often is the use of data, which brings us to today's discussion. It's almost as if this session needs no introduction. We've all seen the statistics when it comes to the mountains of data being generated these days and the speed of data in our world today. A few ones that come to mind, roughly 90% of all data in the world has been generated over the last 2 years. 1 million logins on social media occur every minute. Hundreds of hours of new videos are being uploaded every minute. Millions spent online through e-commerce. And then tens of millions of text messages and hundreds of millions of emails sent every minute, and the list goes on. So what do we make of all this data in the context of financial inclusion? A few questions come to mind to sort of set the scene. First, can this data actually provide meaningful insights on consumers, and in our case with discussion for borrowers? Is there even a viable use case and value proposition for this data to help drive meaningful credit decisioning, help financial service providers and digital lenders say yes more often? And lastly, and perhaps most importantly, are we keeping the protection of the consumer, the individual borrower, front and center when we look at the design for these solutions? So today we're going to speak with 3 organizations. Nithyo, represented by Madeline Gleave, Chief Data Scientist. Masabi, represented by Chris Sharonka, co-founder and CEO. And then Credo Lab, represented by Michele Tucci, the Chief Product Officer, who are in different ways seeking to answer some of these questions. As I'm sure that they would do a better job than I could do to introduce themselves, I'm going to let them introduce themselves. So Madeline, you should see the slides, but please tell us a little bit about yourself and about Nithyo.
Thanks very much, Mark. It's a pleasure to be speaking with you all today. So as he said, I'm Madeline Gleave, Chief Data Scientist at Nithyo. And Nithyo was started a couple of years ago with a really unique perspective. If you want to go to the next slide. In actually working with institutions that are sort of on the border between more of a retail or service model and financial service providers. So we work a lot and we started our work in the solar home system sector, focused on the African continent, to help companies that are distributing solar home system kits to consumers access better scalable financing and have a better perspective of the credit risk of their customers. So we have used a variety of sources of data to help unlock that finance at scale, both from kind of the investor to companies flow, but also the companies flowing to the end consumers. And with the goal of promoting universal energy access through that scalable financing. But we've also started to bridge into other sectors because we recognize that the credit scoring tools that we've built to solve for this problem are very broadly applicable. So really excited to talk through some of those ways that the lessons we've learned from this particular sector we're seeing be applied to other types of financial services and other types of economic services or household services that rely on financing. So you want to go to the next slide. Talk a little bit about kind of Nithyo's secret sauce, or how we approach the perspective of alternative data. So we work with companies that are primarily kind of digital first. So they already have digitized sources of data based on their consumer transactions. And then we help them augment that with a really unique source of geospatial data, which has been derived using machine learning tools from household surveys and satellite imagery to create very, very granular kind of hyper-local estimates of consumer profiles, of household characteristics, which we are then able to create prediction models with to better understand what are the expected repayment trajectories of those types of customers, and actually forecast that for these companies that are servicing them, to better understand, what's the likely cash flows from them for those customer segments, where are they located, what are some of the drivers of repayment risk, and build, a variety of different credit-oriented risk analytics services and products to meet their needs. So I'll stop there.
Great, thanks so much, Madeline. Chris, I'll turn it over to you. Tell us a little bit more about Mosabi.
Thanks, Mark. And yeah, that was great to hear a bit about another approach. Yeah, happy to be here and introduce Mosabi to everyone. So I'm Chris Zerwanka, one of the founders of Mosabi. You see our mission statement on the screen there. So really, we're building what we see as a hybrid platform of both fintech and edtech to try to achieve financial inclusion goals. And essentially, Mosabi is a mobile learning platform as far as a user-facing interface for financial and business and life skills. It's all sort of centered around an objective of helping emerging market citizens improve decisions and behaviors around small business activities and around usage and engagement with money and financial products. So that's the ed tech part of what we're doing. The fintech part of it is that as a business model, we harness data insights from user profiles as they journey through our modules and our engagement. And by way of creating scoring profiles, we match them to the financial services, digital financial services, other offerings of partner institutions that we work with on the ground in a few different countries. So you kind of see on the screen how we like to call this a bit of a virtuous cycle. And the secret sauce of Mosabi is happening on the top of that circle there, where we are gathering in a number of the other sort of interesting alternative data points, working with actually other external providers. So one of a couple layers of scoring that our partners are using. But what we really think is different about the Mosabi platform is, in addition to drawing from these disparate data sources, we're also empowering our users to create new data points across their creditworthiness profiles. And they do that through the learning. So it's being exposed to new topics, demonstrating engagement with financial and business related lessons, understanding of financial concepts and how to be responsible with those products, and then correlating those different topics and journeys and the sort of gamified quizzing and other data that's collected along with it, with their predictive power in terms of correlating with good performance on financial products that our partners are providing. So we're helping to draw push some efficiencies there to our financial institution partners, build on approaches that certainly have been done for a while in terms of psychrometrics and drawing from other behavioral demonstrations to help contribute to creditworthiness, but try to do it in a little bit different way and using a couple different channels to do that. So on the next slide, Mark, you can see a bit about how we're really targeting the lower end of the segments in emerging markets. So underbanked or unbanked, certainly underserved populations who are almost always thin file and have had little to no access to formal financial products. So in order to bridge those divides, we've created user-facing engagement channels on a few different platforms. So we do have a long-standing Android app that we've had live in a number of different sub-Saharan African markets. we've in the last, actually during the pandemic, so during this year, we've used some of the time to really rebuild part of our tech stack and our mobile channels that we've launched recently on iOS phones. If any of you are familiar with this platform, it's referred to as a smart feature phones in emerging markets, where they get data, don't have touchscreens, and the battery lasts about 5 to 7 days. So the value proposition is really strong for our segment. And then we've also built out channels this year for chatbot interaction, WhatsApp, Facebook Messenger, even basic phone text messages, so that if people don't want to install a separate app, they can learn with Musabi, build credit profiles, and match to our providers in any of the channels, and hop among all of them too. So yeah, that's us. Thanks for the opportunity to introduce.
Yeah, you bet, Chris. Michaela, I'll pass it over to you. Tell us a little bit more about Credit Lab.
Yeah, thank you, Mark. Thank you, Chris. And so my name is Michele, Chief Product Officer of Credolab. We are based in Singapore, but we operate today in 22 countries, mostly in emerging markets across Southeast Asia, Africa, and Latin America. If we go to the next slide. Mark, so what Credolab does, we help banks make better credit decisions by developing credit risk digital scorecards. We use a very particular source of data. We use mobile and web metadata that customers generate by simply using their mobile phones. So by developing this additional way for lenders to assess creditworthiness of individuals, we help them to approve more customers, to lower the overall cost of risk, while also enabling a seamless user experience. There is no friction added to the process. And also, we protect user privacy. There is no personal data involved in our credit scoring modeling pipeline. There is only metadata. So if we go to the next slide, we access only privacy consented behavioral metadata. And the idea is that we apply machine learning algorithms to digital footprints that have a lot of value, but unless the information value, unless the correlation with delinquency is properly assessed, then it's difficult to make sense of those. So today we have developed 1.3 million behavioral features on Android devices, and also 2.5 million behavioral features on iOS devices. In the context of financial inclusion and emerging markets, the focus is, of course, on Android. In 52% of all the digital scorecards that we have deployed, we have reached a Gini coefficient above 0.20. And in no deployment, we have gone below 0.10. So the Gini coefficient measures the predictive power of a model. And when you combine a source of data that has no correlation or very little correlation with social demographic data, and even with credit bureau data, when and if available, you're basically looking at doubling the predictive power of your existing model. We won the award as the best fintech in ASEAN last November at the Singapore Fintech Festival, and we are working towards including more people into mainstream financial services at fair term. That's very dear to us. Mark,
Great.
over to you.
Thank you so much. Thank you all three for sharing thoughts on your organizations and kind of setting the scene for today's discussion. So for the next 35 minutes or so, I want to deep dive into a couple of areas around alternative data here. So first, I think I want to continue to articulate further this value proposition for alternative data. Why should we, in particular, financial service providers, digital lenders, and the like, care about alternative data? Second, we're going to endeavor to bust a few myths out there. So we're going to identify a few of the perhaps common misperceptions that exists around alternative data and attempt to arrive at a few general conclusions. And then finally, we're going to look to drive forth a call to actions. Now more than ever in the midst of the COVID-19 pandemic, digital transformation is really taking center stage. So what are some of the implementation considerations when we're targeting some of these solutions? So let's get started. Madeline, I might start with you. From Nithyo's perspective, how have you seen really the use of alternative data, in Nithyo's case, geospatial and other sources, really effectively driving positive outcomes for individual borrowers, both providing responsible access to financing, as well as getting the financial service providers to say yes more often. So we'll start with you and then get thoughts from Chris and Kelly as well.
Yeah, thanks, Mark. I think one of the really interesting things that we have been able to help companies with, as I mentioned, many of them in the solar sector, they're using the pay-as-you-go financing model to make their products more accessible to a wider range of customers, make them more affordable. But what they hadn't necessarily thought of in that way is thinking of themselves as a financial service provider. And that has also included not necessarily really doing much underwriting or thinking about credit risk decision-making at point of sale or pre-point of sale. So part of what we've been able to do is just start from that baseline and help them think about, how do we consider credit risk decision-making processes that are sustainable, that make sense for the types of products that they are working to provide, that don't just kind of skim off the top, but are really about matching the right type of financing and the right type of product to the households that can truly afford that. So one of the unique things we've been able to do with that geospatial lens is say, we have an understanding of what the ground level demographics are in these very hyperlocal kind of community level grids. 1 square kilometer grid is where the resolution we have that geospatial data on. And we can help them really match and target both their sales outreach strategies to think about, where should we be sending these officers to sell products, but also to onboard, kind of originate loans. How should we be structuring the payment terms more effectively, and really help them think about how do we plan our cash flows and our operations, particularly through COVID-19. I think this has become even more pressing for the sector, and think about, how do we understand from that geospatial level up these characteristics that we may not actually be tracking manually for these customers, but we can say, we know that this area has a higher percentage of workers that are employed in, kind of day laborers versus salaried employees. How might they be affected differentially by kind of a shutdown? Where are pockets of kind of health access, and help them build that into their risk models. So, yeah.
Very cool. Very cool. Chris, what about you from Mersabi's perspective? As you were kind of speaking about in your overview, you employ first-party generated data through e-learning that's both empowering as well as providing access. So, same question for you. I'm curious to hear your take from Mersabi.
Yeah, I think a couple things jumped out at me when I was listening there that really resonate. And first thing that was really around this idea of matching the best product with the best fit for someone's context and their economic activity in their household, right? So I think what's super interesting is not only just this idea of working with financial institutions so that they get to yes more often, as kind of the overall question is that we pose, but that they can get to yes more quickly, and that they're getting to yes about that right fit product. And that's where we've tried to center our efforts, especially as we've tried to maintain momentum and still be reaching people and driving our value proposition during the pandemic, is as we've worked with financial institutions that have built Mosabi learning bundles into their screening and onboarding process, they've been able to, yes, of course, say yes more often, but also say yes more quickly and do it in a completely digitized way, as opposed to, having to have boots on the ground staff doing household or business location interviews, things like that. So not only, you know, collecting information, yes, on sort of geography and location of activity and some of the other data points that can help them make that remote decisioning. But having a more holistic view of someone's financial life and health by way of our, you know, sort of gamified way of teasing out their economic conditions and the challenges and daily financial lives events that they face. So as people are going through our lessons and demonstrating that they understand budgeting, demonstrating that they understand keeping professional and personal finances separate, and showing responsibility in financial products, there we're also asking them questions about what kind of products they deal with currently, how their you know, what their proposed use of funds are. As we teach people about budgeting, we're also asking them what their daily and weekly budgeting flows are, what they pay for inputs, what their income flows are, and things like this. So so yes, I think that first party data that's coming together is a way of replicating what previously maybe were very intimidating and very field force predicated application processes for financial products. And yeah, we've been pleased to really help people, especially at the bottom of the pyramid, help go through that process faster so that financial products are deployed more quickly.
Yeah, I love that perspective of saying yes more often, but also more quickly. Michele, I want to ask you the same question, but also kind of, you know, add a little element to it, because I know that from your perspective, you know, the consumer kind of protection element is really embedded in the design process. It's not sort of an afterthought. So same question for you in driving positive outcomes for borrowers, but you know, in how you approach metadata.
Yeah, you're right. Our design, the design of our project is built from the ground up, taking into account metadata, not personal data. So we go to as far as we don't want to receive personal data. We don't want to know your ethnicity. We don't want to know your age, your gender. And the reason is that we don't want to build bias into the models. During COVID, I think most of the most pressing question we have received from lenders was how stable was our score, alternative score. And we don't have the social angle that Mosabi does. So we are purely a B2B company. Our clients are the financial institutions, rural banks, microfinance institutions. And so the questions that we receive are largely about how reliable is your score. And so COVID-19 actually gave us the opportunity to stress test the stability of the score. And we measured data in China, for instance, before COVID-19, during the pandemic and the lockdown, and after. And the reason was that during COVID, in China in particular, individuals spent on average 5 hours more per day on their mobile phones. So with that kind of digital footprint growing, the diversity of the apps being used, the type of behaviors that arguably changed, we were also worried as a company that our score lost a little bit of predictive power. So we went back to the analytical part. We assessed the population stability index, and we concluded that the score lost only 0.03 PSI. And so maybe I'm becoming a little bit too technical, but if the scorecard loses 0.10, then you need to calibrate the model, or above 10, 0.10, you need to rebuild it completely. At 0.03, basically, we were able to identify delinquent behavioral patterns, even where credit bureau score wouldn't, or even where traditional models built on income data and social demographic data or historical data, repayment data, couldn't. So now the opportunity that we have ahead of us is actually to use the score as a way to filter out customers that are likely to repay not based on their history of repayment, but based on their behavior.
Very, very interesting. So you raised a good point, which I think is going to be a great pivot into our next section, kind of around your B2B business model, which is really a part of all three of these organizations. So for this next section, as we look to maybe tackle a few common misperceptions, I'm going to take the role of your customer, your financial institution, and because I think there are, as I mentioned, there's a few myths out there that I think we should look to tackle. So I might call on a few of you. I don't need three of you to answer each of these, but have a little fun with this. I should have had a clip-on tie to put on. So first and foremost, Madeline, I want to start with you. So leveraging alternative data, the geospatial angle that you mentioned sounds fascinating. But that seems like it's going to require us to completely replace our general risk model inside of an organization, and that just seems like too arduous of a task. So please, change my mind in how this is complementary and make better use of the existing data models as opposed to.
Yeah, it's a great question. I think that my background in economics would say that each situation depends, right? It depends on where you're starting from and what that general risk model actually looks like. In our experience, sometimes that's as simple as just, can they pay the deposit or a down payment? And that's really the go or no go that many companies rely on. It's certainly an important indicator, but it doesn't add a lot of nuance or project very far into the future. But some companies, have a much more expansive risk model and have their own features that they're collecting as part of an underwriting criteria, and some heuristics maybe, or even kind of a weighted scoring that they've applied. So as a B2B, kind of similar to what you just said, we provide very customized services for each of the companies that we work with to help them build it into a system that makes sense for them. And I think each of the entities on this call, we all use machine learning to some extent. But one thing that I think is always important when we're designing these solutions is to keep a human in the loop, because you can build a recommendation engine, you can build a scoring engine, but we want to make sure that at the end of the day, there's still the component of being the person on the ground who can take that information as an input into their decisioning process, but it's not necessarily the only criteria that they may be wanting to consider. So we've built a variety of different kind of platforms that can be integrated into their point of sale app, that can be integrated into their, a dashboard or a centralized tool or a decentralized tool. But ultimately, at the end of the day, it's one input that's driven by data that's representative, that can give them a more expansive view and sort of fill the gap, right, of maybe what's not working well about their current model.
Okay. So,
and Mark,
go ahead, Chris.
Yeah, I'd just love to jump in for a minute, because I think what Madeline says resonates so much with me in some conversations I've had with providers in recent months about the idea of layering, right? So I think while we're all working very hard on these machine learning models that Madeline mentioned, underpin our models in our companies, we're never going to be the only screening and scoring lens or algorithm or technology that a provider is going to employ. They'll have some traditional field-based application and screening and perhaps interview measures, and providers will run the gamut in terms of purely all digital automated lenders to more high touch local microfinance organizations in some countries. And I think that's an important lens, is that we can all build up companies that have a value proposition and a niche to be a layer in that screening process, and carve out viable businesses on that, and perhaps be working together on joining up our layers to provide the best opportunities. And yeah, sorry, I'll let you go ahead.
Sure. No, thanks for that. Michele, anything to add on top of that?
I think as long as the different sources of data that flow into the general model have low correlation with each other, any lender that is able to ingest these multiple sources of data, they can only benefit. At that point, although the only question is how much each individual sources of data costs, and so how much how to strike the balance between the cost of adding a source of data versus the savings in terms of cost of risk. But that's also quite easily accessible, and in our experience, we guide our clients. Initially, they are worried, oh, your score costs $1. We cannot afford $1. But actually, when you show them the impact on the bottom line, they realize that perhaps they could even spend $2.50 and still save on cost of risk, and still accept more customers than they would without CreditLab, for instance. So yeah, there are lots of considerations. I go back to analytics a lot because at the end of the day, this is what is driving the risk side, the risk assessment of individuals.
Got it, got it. So Michaela, I'm going to stay with you. So you all three of you, you've convinced me on myth number one. But Michaela, what you're saying though does sound like it requires heavy IT integration on the part of my financial institution. So once again, tell me why I'm wrong on the heavy IT integration. I know that you have experience, having done this with more minimal efforts. Go ahead.
Yeah. So okay, the kind of institutions that we work with are not always, they don't always have the best IT teams. And so we built our solution by keeping in mind the limited IT resources that could be made available for an IT integration. So the lightest touch integration is one that requires no integration at all, actually, only a change in the user journey to allow for a simple mobile app to be downloaded. So we don't even have an API connectivity into the loan management system. We have a web dashboard where the score is available in real time. The app is white labeled by us, by CreditLab, so we don't need the lender to do any development there. And also from a scoring point of view, data modeling point of view, we do the heavy lifting for the bank. In some cases, we also develop the model for them. So it's almost like a managed service kind of solution that requires nothing from the lender. A little bit more onto the integration side, depending on the current system, then you have a mobile SDK that can be integrated into the lender's existing mobile app. But even from an SDK point of view, it's a library of code, only 200 kilobytes, that can be integrated and tested in 2 days only, and then republished on the app can be republished on Google Play. The API is a RESTful API, webhook. So there is nothing complicated about it. The analytical part is the most complicated, but we do it for our clients.
Got it. Okay, you convinced me. Madeline, Chris, anything to add on this one? Go ahead.
No, I was going to say, I think that approach is very similar. Like I was saying,
right.
It's sort of the core model. I think one distinction with Nithio is and maybe not a distinction, but just to raise the point again, we use whatever data that the company is themselves collecting, right? Whatever system part of the work that we take on is to standardize and map to that into the model and then deliver it in a very flexible way. So yeah, echoing what Michaela said.
Got muted that part. Okay, very, very interesting. All right, I'm stumped again. So here, I'm gonna move on to another one. Let's take it sort of outside of the institution. So Chris, for you, it does seem though that just smartphone penetration is still too low to really sort of warrant an investment on behalf of my financial institution into alternative data solutions. So you mentioned sort of some of the kind of new deals that Wasabi has been targeting. So talk to me about that and how you sort of see the future on the hardware side, which is really so key to driving you know, this alternative data solution.
Good job, Scott.
Go ahead, Chris.
Yeah, that's a good question, Mark, and it's certainly one that's been at the heart of our approach, and at the heart of a lot of alternative data-focused companies, like all of us. You know, I think especially a few years back, there's tremendous enthusiasm to build and replicate this idea of having, you know, smartphone apps that could gather the type of insightful data that could really build, you know, business-worthy models and companies on that. But it's, you know, in a lot of the markets where we're working, of course, that smartphone penetration isn't a hyperbolic curve. You know, it's not happening quite as fast as maybe everybody was hoping 5 years ago. And we're not rushing to this future where everyone has an iPhone or a fancy Android phone. But I think you're right. We are seeing hardware innovations that play into the alternative data space, where that sort of mix of device use among clients is actually interesting in contributing to understanding of alternative data or other factors and behaviors that go into creditworthiness. So, you know, I mentioned a little bit in our introduction, but we've definitely, you know, taken a newfound focus on this multi-channel approach this year to be teaching our same core models and have our same core infrastructure running our data science and running our machine learning that's taking into account the various channels in which our users are interacting with our content and how they're engaging with the channels by which they find out more about our partner banks products, et cetera. So I think the very fact that one user, you know, is still using a basic phone to do that versus maybe having a bit more spending capital to be buying a more expensive smartphone, that's interesting. The other thing that we've been working on this year is with that operating system maker, KaiOS, that we're working with. We're actually working with them on pre-financing a low-income individual's first purchase of a smartphone or a data-capable low-price phone. So in that case, for a thin file or a completely financially excluded customer, that purchase of a phone with the underwriting institutions that we're working with is actually their first formal financial product. Even if it's just a $15 or $20 KaiOS phone, that's it's providing someone that growth pathway to other products that a formal institution can provide them. So I think that's a true statement you started with, but it also contributes to the sort of you know, interesting array of data points that can help go into all of our models.
Absolutely. So Michele, convince me here, because I think there's something there, but are we creating enough data points to effectively develop predictive models at scale that also provide, you know, meaningful uplift for financial institutions? You have a perspective on that?
Yeah, I think lack of data is the main problem why especially banks are not able to approve more customers. So if on the panel itself, we have 3 different companies, all of them handling alternative data, all of them handling different types of alternative data. So I think a localized approach is the one that will work in the long term, starting from what is the definition of alternative data? Alternative to credit bureau data, alternative to credit history worth of data. But as Chris said, if somebody doesn't have any credit history because they don't even have a prepaid SIM card, then what kind of data are we looking at? So, and that's where behavioral data comes into play, because it is widely available, you know, and if it is assessed in the right way, it can also be very predictive. And so the lack of data and lack of predictive data in any given country Smartphone penetration, perhaps Southeast Asia is at a different level of sophistication compared to some countries in Africa. However, and I'm going back a little bit to the previous myth, when we talk to digital lenders, for instance, those that acquire customers via digital channels only, they tend to focus on urban areas, not rural areas. Mm. So in urban areas, smartphone penetration is usually higher than in rural areas. So it also depends on the kind of client that we work with, the kind of the type of customer segment that we work with, and then the availability of either data coming from smartphone or feature phones. I love KaiOS, by the way. It's an incredible product, and it's they are really exposing a lot of people to the internet for the first time, and to education and to financial services. So I wish I could do a partnership with KaiOS. If any of them are listening, please. So no, long story short, I think there are a lot of data available, data types. We just need to find the one that is relevant for a particular target segment in a particular region.
That's great. So I've learned that I need to be more prepared before getting in the ring with you three. So four myths bust. But I want to try to make one last stand here. And you raise an interesting kind of perspective on geographic differences, both like within a country, between urban and rural areas, but also across regions. I know all three of you have had your origins in sort of one specific area, but have really seen applicable solutions, analogous in other areas. So Matt, let me start with you as an origin in East Africa with the Pagos sector. Tell me why I'm wrong in that, in thinking that, they simply aren't applicable across regions. Why are you taking sort of a global approach to NIFIO?
Yeah, before I answer that, I want to just
Sure.
add a second perspective on what Michele just was talking about and I mean, it is related, but that different entities in terms of what data is available can have different types of modeling solutions. And it's really about how do you improve upon what's the comparison, right? Like what's the alternative scenario? So because we take a perspective of using the geospatial data, right, which includes, it's derived from representative household surveys and satellite imagery, which exists for, I mean, it's not offering a specific view of an individual customer. So it's not used in that way, but we can take a layered approach for an entity that really doesn't have any of that existing customer data, but still wants to find a place where the characteristics of that area are likely to produce, credit-worthy customers for their type of product. So even starting from zero, the work that NIFIO does, because we draw on these types of alternative data, it's not individual-based, but it's place-based. So in order to then be able to take the learnings from one place to another, right, it requires that geospatial data is standardized and comparable. And so that's also part of the innovation work that we've done and that our data partners have done, is to actually go in and understand how those survey data sets compare, how they can be harmonized and made very accessible at a very granular level, which is essential for doing any type of machine learning at scale. So I think the main point of, can learnings be transferred? Certainly geographic nuance exists, but in order to even understand that nuance, you have to start from a comparable baseline, and that's what we do. But I do think that the other points, in being able to transfer learnings, even from one sector to another, NIFIO is now working in the agricultural financing sector or with microfinance institutions, is to figure out what are the dimensions that you can normalize. Is it the loan terms? Is it the lending model, the household demographics, the kind of the onboarding processes? And how do you control for that with machine learning, which allows you to both work with a lot of nuance and give very nuanced predictions, but also standardize across, a lot of different contexts.
Very interesting. Chris, Michele, thoughts from your experiences in sort of transferring solutions across regions, across borders?
Yeah, we made it mandatory to have a standardized JSON file, and JSON file is the outcome of the mobile app or the outcome of the SDK. So it's the map of the digital footprint that we access, and it's always the same. It's the same in Indonesia as much as in Nigeria, Brazil, or Mexico. So that allows us to transfer learnings also from one country to the other. So today we have developed a model based on about 32 million data sets, and we have identified some micro behavioral patterns that are always somehow predictive across all countries, despite cultural differences, despite the nuances that you may expect going from Indonesia to South Africa. And yet, the way we use smartphone is pretty much standardized across also Android or iOS. So in that case, we developed two different scorecards, and we go granular also in terms of operating system. So we have within the Android scorecard, for instance, we have one scorecard for Android 10, Android 9, Android 8, and so on. But while listening to Madeline and also Chris, I realized that we are not really at the bottom of the pyramid in terms of target segment. We probably are, as type of clients that we work with, a little bit higher, still new to credit, still new to bank kind of clients, but not the bottom of the pyramid.
Great. Chris, any thoughts on sort of the expansion of Musabi's origins in West Africa in context to other regions?
Yeah, I'll build on what Madeline and Michele said. But essentially, yeah, we take much the same approach of having scalable baseline models on our. We have two sort of algorithms that we're running. One on risk, that's sort of a bunch of disparate alternative data in a more traditional sense, but then our preparedness algorithm that is based on the learning journey that a user goes through and builds in their profile. And we do see, we work in vastly different markets where the sort of target end user learner is in vastly different circumstances and being exposed to and interacting with and onboarding with different types of financial products. So I think there's the differences among geographies, but then even within there are, as Michele said, we're tackling different ends of the spectrum in terms of demographics and segments. And it's really interesting to take a look. We've done the same thing and seen these common threads across geographies and even within segments from base of pyramid on up. But I also do think, Michele was right. Musabi is a social enterprise, and we do have a more lower tier segment target, and have this ambition to build people out of poverty and build financial health among lower income, underserved people. And there is a tendency in emerging markets, I think, that they're often the Wild West in terms of data privacy and in terms of the level to which experimental algorithms are maybe rushed to market. We're trying, we're early stage, but we're trying to make the good decisions on the front end with that. And I think there's an opportunity for us all to, it's probably a whole nother webinar topic, but the idea of ethical algorithms and sort of social responsibility and designing models and machine learning. There are some sort of sector working groups that are popping up. I see some people on the call who have worked with me in Accion's FinTech Protects working group that helps to advance these types of responsible practices. And so I think in terms of comparing geographies, especially as we move to lesser developed countries, and then especially if we are talking about solutions that serve the lower end of the segments, those types of responsible best practices are important.
Yeah, I believe if I'm making a plug to have everyone go back to the financial inclusion page, but because I believe earlier this morning there was just a webinar around kind of responsible algorithms. So plug to go check out that recording if it already happened, or watch it if it's coming up later today. I'm looking at the time. I know we're sort of coming up to the end of the hour, and there's a few questions that are kind of coming from our audience into my chat window. But I wanted to just put each of you kind of on the spot for what is the call to action, in your B2B business model, in the financial institutions that you are speaking with. And I'll sort of try to sum it with one where, if there's an FSP interested in developing a focus on our alternative data, whether it's e-learning, whether it's geospatial, where it's sort of metaphone data, where should they begin? So I'll have you sort of each answer that in kind of a sort of a short mention, and then we'll sort of go to a few questions that have been popping up the window. Madeline, maybe I'll start with you as we did at the beginning. Where would one begin when thinking about implementation considerations for alternative data?
It's a great question. I'll try to keep my answer very short and pointed.
Sure.
To something that comes up a lot. Collect GPS coordinates of where your customers are, because that opens up, I think, so many possibilities for how to add on other sources of data, how to standardize across those data sets. That if you don't have that, or at least you're not collecting it in a rigorous way, it does make it more challenging. Not impossible, but more challenging.
Got it. Good one. Collect GPS coordinates. Chris, how about you from Wasabi? I think we might have lost Chris's audio. Michaela, I'll turn
here. Yeah, go ahead, Michaela.
Okay.
I think I will take my Credolab hat off, and I would ask these financial institutions to focus on the problem they're trying to solve. And then for that particular problem, identify the type of data that they really, well, first of all, is available to them. And if they have multiple choices, the one that will help them solve the problem faster.
Awesome. Very, very important. Chris, are you with us?
I am. Yeah. Sorry,
Okay.
I got stuck on mute there for a second.
No,
but yeah, I think it wouldn't be a surprise from you guys, but my big takeaway would sort of bridge off what Michaela was talking about really call to action for providers to think about product design and the right fit for their segments before they're thinking about the type of alternative data and the type of providers or platforms like us that they might work with. And I think there are opportunities to be responsible about that, to bring algorithms and machine learning that are proprietary to the market, but make them understood to an extent that there is client protection, that consumers are understanding, the use of their data, empowered to say yes and opt in. And if we can sort of, move forward responsibly in that way without the total full-on breakneck speed that innovation sometimes takes, then the stability of the sector will be better for it. Great.
Well, so I'm going to turn to the audience here. So from Leon, this is a question for Madeline, for you. If you're using geographic COVID data to adjust risk models, aren't you worried about discriminating individuals? For example, zip codes cannot be used in the US because there sometimes can be proxies for race. So what's your approach to limit biased decisions when using geodata?
It's an excellent question, and definitely an important one. So it goes back to what I said earlier about having the algorithms and the scoring be one input, first of all, that it's not the only kind of automated decision that you're going to take. Ideally, and this is what we strive to do with our models, is to identify what are those drivers that seem to be correlated, right, with higher repayment risk, and understanding, are there other mitigating factors that we need to address to adjust that? Is it a lot of one that came up recently was kind of an index of vulnerability, right? As obvious, I mean, it's obvious, it's not surprising, but what does that mean about the other resources that need to be crowded in to help address that? It's still the reality that the companies are facing, that is, you know, that is one of the drivers of credit risk. But one of the things that we're doing at Nithio is trying to take kind of an environmental perspective, an ecosystem perspective. We work a lot with, you know, DFIs, with governments that are trying to help increase energy access, for example, or increase financial inclusion, and helping them know where are the customers, the households that are the most in need of the most concessional assistance, and actually targeting that assistance to them, and having the distributors be able to access those resources, whether it's a subsidy or a voucher program, to serve all of those customers, while still maintaining, you know, their bottom lines and being sustainable companies.
Great, really, really important. So I know we have 2 minutes left. I'm curious if there's any other questions from the group here. Feel free to come off mute or type it in the window. But in lieu of any sort of final questions, I just want to take the time to thank each of you, Madeline, Chris, and Michele, for you know, joining me on this discussion to talk about the opportunities and the risks around alternative data. Each of you are taking a very, very interesting kind of angle at that, and you know, I think it's really driving impact in the sector. So thank you all for being a part of this session for Financial Inclusion Week, and thanks to Axion and CFI for our hosts and our sponsors for this week.
Yeah, thank you.
Thank you all.
Thanks everyone for listening in. Have a wonderful
Thanks,
weekend.
everyone.
Take care. Bye-bye.
Bye-bye.
Bye.